So you've decided you want to invest in growth stocks. You've done a little background research and you know that growth companies are usually expected to expand faster than businesses that are more established. But there often isn't as much of a track record to reference, so how can you distinguish a promising growth stock from a mediocre one? Well, there are some telltale signs that can serve as clues, and we're going to run through 5 common ones here. You can find all of them in a company's financial statements. And of course, this is by no means an exhaustive list, just something to get you started. But with that said, let's get into it. Number 1, rising revenue. A business will have a hard time growing if it can't raise sales over time. So find the revenue line in the income statement and look for a history of increases each year. This suggests the company's products or services are gaining traction with customers, giving it a solid base from which to grow. Number 2, improving margins. Rising revenues are only beneficial if a company earns more money from each sale. That's what net profit margin measures. Just divide net income by total revenue and multiply the result by 100 to calculate the percentage. Improving profit margins suggest a growth company is becoming more efficient at making money. Number 3, increasing earnings per share. Earnings per share, or EPS, are the holy grail that most investors are ultimately after. When they rise over time, it means a company is growing more profitable and able to generate more money for investors. Growth investors also want to see strong earnings forecasts. That's because they're usually interested in the stock's long-term upside. And you can find these projections in a company's quarterly and annual updates. They're also in stock analyst reports for easy reference. Number 4, a healthy return on equity, or ROE. This metric indicates how effectively a growth company can turn money from its investors into profit. A company with a rising ROE that's higher than its competitors is probably making smart investments with those funds. A low or falling ROE might suggest management is struggling to deploy money effectively. Just know that it's generally best to compare companies within the same industry, since operating conditions can be very different from sector to sector. And number 5, a manageable debt load. Growth companies that hold a lot of debt might have a tough time growing their business. The interest payments they owe will eat into any money they would otherwise have to expand. It's especially worrisome when a company doesn't generate enough cash to cover near-term obligations. So dive into its balance sheet and compare cash and cash equivalents with total current liabilities. A wide buffer between the two usually means the company isn't biting off more debt than it can chew. Okay, there's our list of the 5 common factors to look for in growth stocks. You can use the research tools in Webroker to help you hunt down growth stocks that fit the profile. Just fire up the screeners tool to filter for stocks that fit some or all of these criteria. You can also call up a company's overview page and click on the Fundamentals tab. Here you'll get a breakdown of its key financial metrics plotted over time. That makes it easier to find those upward trends that could signal opportunity. Not much of a number cruncher? That's okay. Many investors use analyst reports and recommendations to supplement their research. Just click on the Analyst tab for a look at the latest updates on the stock. You can also visit the Analyst Center for other investment ideas that might fit your research criteria. And of course, this is just the tip of the iceberg. Make sure to watch our lesson, How to Research Growth Stocks in Webroker, for a more detailed walkthrough of how it's done. And you can always attend a masterclass for guided instruction from our team.